Good morning, everyone. Welcome to NDB Bank's earning call for first half 2020. And with me, I have my senior leadership team, Sanjay Prada, Senior Vice President, Retail and Personal Banking, Deepal Akuratikama, Chief Operating Officer, Niran Mahawat, Vice President, Treasury, Vikas Kanavira, Vice President, SME Banking, Vinod, Vice President, Personal Banking, Suendri Muthukumar, Vice President, Finance, and Shanka Bewana, Vice President, Corporate Planning and Business Intelligence. So, as usual, before moving on to the presentation, let me very briefly highlight the impact of COVID and also how the NDB Bank has responded to the situation. As we all know, country went through a very intensive lockdown period between mid-April to up to end of June. But I think that globally we are still saddled with the epidemic. Every day we are receiving quite high numbers. Impacted in, especially India is quite badly affected these days, India, Bangladesh, and also the South American entities, and also US. So for total death exceeding 750,000, and then total impacted people more than 21 million so far. But I think thanks to very proactive measures taken by the government and the medical officials, I think we have been managing it relatively well. So I think it's important that we keep those controls intact. Impact to the economy is quite severe. We have seen the first half, actually the first quarter, there's a negative 1.6% growth for the country. Expectations for the second half are all negative, ranging from negative 1% that the Fitch has rated, and also a highest negative 6% by ADB, and World Bank around negative 3%. So all in all, I think everybody is expecting a negative growth rate for the GDP for 2020. But hopefully there will be a rebound expected by 2021, which Central Bank, which all have indicated a rebound in 2021. So let's have those positive expectations maintained. In terms of managing the COVID, bank, along with the entire banking community, supported, first of all, I think ensuring that the payment arrangements are covered. We also went up to the level of having our mobile unit converted to mobile ATMs. So we deployed about 3 mobile units, and also using our digital platforms like the Bank to You, and all managed to go and serve the clients during that period. And branches also, we kept them open with a work from home arrangement, and about 1/3 of the staff managing. And I think as a result, there were a lot of positive learnings also that we are applying in terms of managing the workforce and also managing the cost side. So a lot of customers were impacted. In NDB's case, we have given about 40% of our exposure. We have given them moratoriums, both regulatory-driven moratorium, ranging from 2 to 3 months up to 6 months. But in some cases, we have identified these customers and given moratorium beyond that, because some are severely affected. So 40% of the portfolio was impacted by the moratorium, and some are gradually coming out. We see some of them coming out from the moratorium and have started repayments as well. So those are the positive developments as well. We also, immediately after the COVID, we also introduced Chayagam Sri Lanka product, which is a dedicated platform for SMEs and also innovators, especially export-driven innovators. So we see quite a good traction. We have a lot of engagements with Export Development Board, the Ceylon Chamber of Commerce, DARAS in terms of getting a trading platform, and also Code 360 on an export platform. Like that, I think we got several parties to work along with us, and then we see good traction there. And also, we ensure that the relief measures are executed in a very efficient manner. Despite there were certain naturally allegations for delays that you would have seen on papers and all, I think in the case of NDB, I think we have been giving these relief measures as much as possible in a faster manner. So as a result, as of now, the total debt, the Saubhagya loan scheme that we have granted has now, the loans approved has cost about 7 billion. And also we have granted about, out of that 7 billion, about 5 billion we have already dispersed at 4% to deserving customers. The moratorium granted was more than 170 billion. And that there is an impressive impact that you would see in the accounts. Also, there's a first day impact as well. When you discuss about the details, you would know that. So those are quick updates about the COVID-19 situation and how the NDB has responded. Moving on to the business overview. This is basically the NDB Bank's some information that they leave it for your references. Of course, 113 branches, staff close to 3,000, 40 years operations initially as a development bank and now fully fledged commercial bank. So on to the financial performance. That's a key highlight of this investor call. So this is at a very high level how the profitability, the balance sheet, and the efficiency side have performed. So our operating income we had these are comparison from the first half of last year versus first half of this year. So operating income, there's 11% growth from 11.5 billion to 12.9, almost 13 billion. Operating expenses, we have managed to keep it flat, which is a remarkable achievement, I would say, despite the personal expenses and all. So that is at 4.7 billion flat. And profit before all taxes, that again, we have recorded 5 billion, and that also remained flat despite all this challenging environment. However, profit after tax, of course, there's a 34% increase to 3 billion from 2.2 billion. That's mainly due to the changes in the tax and also the debt service levy, the removal of that, and also the tax rate. There was an adjustment down, so that has helped us to have a higher profit after tax figure, which is a welcome move in a challenging environment like this, which helped the banking community to manage the internal capital generation to face these challenges. In terms of the balance sheet, I think we had a very healthy balance sheet growth under the circumstances. These are year-end balance versus the June 2020 numbers that we are comparing. So there's a 6% growth in the total assets from 530 billion to 562, so 32 billion increase. Coming mainly from the loan book. Loan book grew by 5% from 409 billion to 429 billion, so 20 billion healthy growth in the loan book. And the deposits, that's a bigger growth, 6% growth from 405 billion to 428 billion. Again, 23 billion healthy growth in the deposits. So that's on the balance sheet side. I will discuss these in details later on in the other slides. Moving on to the efficiencies and the other return KPIs. I think the key important element is the cost-income ratio, the improvement there. From around 40% 2019, we have improved our cost-income ratio to 36.2. I think that's one of the best in the industry. The NPL ratio has deteriorated from 4.77 in December to 5.4. 5.4% is also the industry NPL ratio that has been published by the central bank. So this is something that we are working hard, but naturally with the current situation, low growth environment, the last year, the Easter attack and the political changes and all, plus this year, the COVID all have resulted in a segment of clients having difficulty, the money circulation was lower, so all have contributed to stress level in the credit side, so that is reflected in the NPL. But we have been managing around the industry NPL level or something lesser than that, and this time also we are within the industry NPL level. Interest margin is again, we managed to get 3.2% compared to 3.5% in 2019. This interest margin is the total interest income divided by the total assets. So that here it's not only the interest bearing assets, we take the total assets when you calculate the interest margin. A slight reduction to 3.2, but still a couple of reasons. Again, the reduction in the margins over the last 1.5 years in terms of the deposit rates, the lending rates, and also the regulatory driven expectations as well, and all of that resulted in lower interest margin compared to previous year. Return on average assets, again, this is before tax, from 2 times to 1.56 times, and the return on average equity that has slightly declined from 13.7 to 12.18, but still I would say these are above average return on equity when you compare with the other financial the banks and other finance companies. So moving on to some more further details on the income side. This is on the fund-based income. So interest income, there's 5% growth in interest income from 25.9 billion to 27.2 billion on the interest income side, mainly due to the growth in the interest-bearing assets. On the other side, the interest expenses, again, 6% growth because our liabilities have grown. So 17.3 billion to 18.4 billion. So as a result, the net interest income, there's a 2% growth from 8.6 billion to 8.8 billion in terms of net interest income. This is despite the growth in the asset book when you compare first half last year versus first half this year, but mainly due to the margin compression that of course there's a growth. However, its growth is not substantial compared to the assets. So a couple of things that resulted in that we had a quoted debenture that was issued in early part of 2019. So that has also contributed to some high increase in the interest rates. And also, as I mentioned, the expansion into the deposit base also were a couple of reasons for that. But NIM and the business volumes, as I explained, we are closely watching this. But I think going forward, we should be working hard on that. We have seen some good positive signs in improvement in our CASA ratio. It has improved to 22%. With also the cost management and also the right products, new strategic direction that we have been devising. I'm sure we can address this as we move forward. So the graph shows how the interest NIM has moved from first half 2019 to the first half 2020. So around 3.36% in June. By end of December, we improved to 3.53. And again, it has been hovering around 3.2 range in the 2 quarters of this year. But substantial drop in 1-year T-bill rates, you note 8.7% in June last year versus 5.66% 1-year T-bill rate. And AWPLR also there's a big drop from 11.45% in first half 19 versus 8.78 in first half 2020. So these are quite substantial, more than 300 basis point or close to 300 basis point drop in the AWPLR. So the margin compression is seen in the market, and naturally as a result, we have been still, yes, there's a compression, but managing around 3.2 which is, I think, it's acceptable given the situation. And moving on to the fee-based and the non-fund-based income, there again, fee and commission income that remains static around 1.7 billion. First half, of course, there were reductions in terms of some of the fee income. There were regulatory-driven moratoriums also given for some of the fees. There were fee waivers on the card side, then the check return charges and all. So there were quite a substantial reduction on those things. But despite that, we have kept it around 1.7 billion. The non-fund other income, of course, there's almost 1.1 billion increase thanks to gains from the government securities portfolio and also the gains from the financial assets, capital gains. So that has contributed to about 1.1 billion when you compare first half last year to first half this year. So total non-fund based income, there's a 39% growth from 2.8 billion to 4 billion. So that's quite a healthy growth. And if you look at the graph where fund to non-fund based income composition, there's a substantial improvement from last year first half, where fund-based income contributed 76% and non-fund 24%. That has improved to now 73% from fund-based and then non-fund 27%. So this is a healthy development, and this is something bank has been strategically focusing on in terms of improving our fee-based revenue compared to the fund-based revenue. So total operating income has improved by 11% to 12.8 billion as a result. This is a very important slide because everybody talks about impairment and very, very topical, given the current situation and all. All in all, compared to last year, we had 70% growth in our impairment. We have taken a very, very conservative approach. Individual impairments for the first half was 1.7 billion versus 1.9 billion last year. However, the collective impairment side has a substantial increase, almost 1.1 billion compared to the last year, resulting for the 6 months, 952 million collective impairment. And then on the other provisions, we have taken the first day impact of day one impact of the moratoriums given the time value of the money or the interest income that we have realized, and also for the resultant credit risk. So we have taken almost 600 million first day impact, and which is reflected under other provision of 479 billion. So all in all, the total impairments have crossed 3.1 billion for first half compared to 1.8 billion. So almost 1.3 billion impairment increase. Collective impairment, of course, mainly due to a loan growth as well. That's a year-on-year loan growth of 56 billion. However, the models and all naturally throws some higher impairment numbers. So we have been very conservative in taking those impairment numbers. And then on the non-performing loan side, the gross NPL ratio has also gone up to 5.4. So from 4.56 in first half 2019, about 100 basis point increase over the year in the NPL, which is also reflected that in the industry NPL growth was again something similar in terms of about more than 100 basis point increase over the last 1 year. Operating cost, again, good story. We have managed to actually slightly reduce the total operating expenses from first half 2019 versus first half 2020. So total operating expenses has come down from 4.663 billion to 4.655 billion. Personal expenses, of course, that's about 4% growth These were related to the staff increments and all. However, quite a substantial savings in terms of other expenses, even for the staff compared to last year, 2 billion, that's 1.883 billion, almost 120 million savings so far. But we expect more savings to come in the second half because the cost management drive and also the automation of our processors have helped us to save a lot of costs. For example, more than 14 workflow solutions that have been deployed, then the Six Sigma practices that we introduced, and also the robotic process automation have helped us to manage these high volumes with the same number of staff. That has improved efficiency level. Then also the bank went through a very comprehensive cost management drive, and of course the COVID situation also helped us to think differently and also manage a lot of controllable costs. That's why I said that in the better half of this improvement will come in the second half. So all in all, quite a good improvement in the cost management side, which is reflected in the cost-income ratio. If you look at the graph given for the year 2016, our cost-income ratio was 49%. Over the last 4 years, how it has reduced to 45% in 17, to 39.3% in 2018, similar 39% in 2019, and now 36.2%. So that is actually quite a good growth for a mid-sized bank. I think we are now comparable with even the larger banks, and I'm sure this cost-income ratio is one of the best when you compare the numbers of the results we declared so far. Moving on to the taxation and the overall profitability, total tax paid from first half last year 2.7 billion, it has come down to 2 billion 59 million. That's about 26% reduction thanks to the removal of in BT and the debt repayment levy, and also the revision of the VAT on financial services from 15% to 8%, and also the income tax rate reduction that is effective from 1st of January this year. So all these have helped us to improve in terms of tax saving. The effective tax rate from last year, it was at one of the highest, 56%, it has come down to 41%. So that actually substantial savings that is going to help the bank, and not only the NDB, the entire banking community, in a challenging time like this to retain the capital and preserve the capital, because post-COVID, the support that is needed and all, we need to have a stronger banking community to support this revival. And I think that way, these savings will certainly improve the bank's capital position to support these clients in a more confident manner. Moving on to the balance sheet. Again, despite challenges, a good story. Total assets have crossed 562 billion. So this is a comparing with the December 2019 numbers. So since December, it's 530 billion to 562 billion. But if you look at first half 2019, it is 490 billion to 562. So all in all, about 72 billion asset growth year on year, which is about 15% year on year growth. But if you look at year-to-date growth, it's 6% year-to-date growth. Loan book crossed now 429, 430 billion. Again, as I mentioned earlier, 20 billion growth for the quantum growth for the year-to-date, which is 5%. But if you look at the year-on-year growth, it's 57 billion or 15% growth year-on-year. Deposits had a better performance in terms of, and that's an area that bank was concentrating to get our advanced deposit ratio somewhere around 100 or below 100. So as of now, we have reached below 100, about 98%. That was one of the imperatives that we have set ourselves. So deposit growth for the first half was 23 billion, a 6% growth. But year on year, the deposit growth was 73 billion, a 21% remarkable growth. If you look at over the last 4 years, our cumulative growth in the deposit rate base was 25%. I think the highest among all the banks over the last 5 years. And so is our lending growth of cumulative growth rate of 21% over the last 4 to 5 years. So in terms of the loan book, one good strength is that the composition is not concentrated in any particular area. It's quite a well spread industry. The composition is quite well spread. And also term loans and trade loans have seen quite a good increase from all business segments. The growth has come. In terms of the currency composition, local currency to foreign currency, the rupee foreign currency book has again improved to 80 to 20. Now this was somewhere around 75 to 25 about 4 years ago. That's again a conscious decision that we were gradually building our exposure to the rupee-based lending. So now it has improved to 80-20, and that remains quite a good ratio to manage with. In terms of funding, again, foreign currency to rupee funding again is 80-20. So that also shows that both the lending side, also the balance sheet mix is 80-20, and funding side also is 80-20, which is a good situation to have in terms of managing the currency risk. So we have a very active ALCO process happening, and all these things are looked at very carefully. There's a 7.4 billion or 9% increase in CASA. That is a very significant improvement when you compare a bank which was hovering around 20% CASA ratio. Now, as a result, we managed to cross 21% CASA ratio for the first half. And more importantly, this CASA growth has come from the retail side, which also confirms the more granular CASA base is improving. And that shows the NDB moving to all corners of the country and becoming a more bankable proposition for all the clients to have that comfort to have their day-to-day savings and current accounts maintained with us. So that's a key growth area that we are also focusing on. In terms of funding, there's a substantial reduction in borrowings because of the growth in the deposits. So about 10 billion Tier 1 debenture was paid in June, and also the repo borrowings of 8.8 billion. So all in all, the balance sheet is quite a good growth. Loan to deposit ratio as at June has improved to 100%, but as I said, I think since then a further improvement to about 98%. And total assets at the group level, including the group companies, now stand at 567 billion. This is on the capital and the liquidity situation. So the Tier 1 equity level remains at 9.3% for the bank, whereas the minimum is 6.5%. Group level it is 10%, and Tier 1 capital ratio, where the minimum requirement is 8%, we are at 9.3%. Total capital ratio is 12.94 versus minimum of 12%. This would get addressed very soon with the what we have announced, debenture raising of 5 billion with the option to go up to 6.5 billion. So there'll be a EGM next week, and with that we are planning to finalize the debenture raising time. So with that, the total capital ratio is expected to improve further. Liquidity coverage wise, we are very much above the liquidity requirement. Now, Central Bank, of course, also adjusted the liquidity requirement, the minimum to 90%, but even with that, but still we are quite liquid in terms of its 135% liquid coverage ratio, and net stable funding ratio of 106 when the minimum is 100%. So all in all, I think the bank is quite liquid and capital-wise, Tier 2 raising would ensure that our the total capital ratio will improve. And later on, we will work on Tier 1 capital raising as well to improve on the overall capital position. These are the investor ratios. Of course, share price has got a battering 76.9 as at June. We have seen a uptick of the share price movement in the last few days, especially after the elections with the political stability. Earnings per shares remains around 21.56 and ROE 12.18 versus 13.7 full year last year. Book value of the share has also improved to 184.2 compared to 178 rupees last year, and price earnings of 3.6 versus 4.3. Price to book value, this is something I think it's only 40% when you compare to the book value. So there's tremendous value in the share, naturally, which is expected to grow in coming months. In terms of share price reduction, it is in terms of the wider market movement. Price to book value is now less than 1 time, and 40% is the figure. I think one upside potential that we see is the NDB subsidiaries, which are mainly in the capital market cluster. NDB Investment Bank as the leading investment bank in the country, or NDB Wealth Management as the leading wealth management and the unit trust company, and also the stockbroking firm. All three entities are expected to gain, especially after the political stability. And we see quite a good traction, especially with the bank and the capital market cluster working together. We see a lot of debt structuring opportunities coming our way. NDB Wealth has crossed about 150 billion in terms of the total assets under management. And the stockbrokers also, we have seen quite a good active improvement in the stockbroking activity. So I'm sure the better numbers are expected in the second half for the capital market cluster. So I think we have to now look for the future, because I think the worst period for the capital market cluster is over, and now we can look forward to some good improvements coming from the capital market cluster. So that would augment well for the bank's overall returns, as these are almost 100% subsidiaries of the NDB Bank. So that basically ends the prepared presentation. So I think now we have time for the questions, and you can post the questions, and then I will read out the question and provide the answer. And in providing the answers, my other colleague will also join in with me. Any other questions?
Hello, everybody. You can please use the chat option to pose your questions.
There's one question: what is the expected growth projection for the second half? As I mentioned, varying numbers given, ranging from -1% to -6%. The central bank is yet to come up with their numbers. There are anything on this? Yeah. So, but it will be a negative figure, certainly, because it will take the economy to revive. Even the tourism sector, which is badly affected, naturally, it will take a longer time to revive. But some of the positive sides that we are seeing are the export side and also the agricultural production. I think the harvest wise, I think our country is expecting quite a good harvest. Then on the export side, the first time we are shown year-on-year growth for the month of July, more than $1 billion export growth. So that is quite a positive improvement. And we have seen even our clients who are in the export side doing well. So that's one good opportunity. I think with the COVID, that has given the country also so many other options. I think when some of the global markets were relying on some large suppliers, maybe they from China and some of the regional countries, now they have realized the value of diversification of their supply base, and that has created certain opportunities for Sri Lanka. And I think Sri Lankan companies also have taken good advantage of that, but there's a lot more that we can do. So actually that is why we also came up with the Jayagam Sri Lanka product to help these exporters. But all in all, still most likely it will be a negative growth for the first half. But we are very positive about quite a faster revival in 2021 with the political stability and political direction coming. I'm sure that would be a good, faster turnaround for the country. There's a question on moratorium, mix of moratorium given for 6 months versus less than 3 months.
In the less than 3 months category, it's around, if you take on overall basis, it's 40% of the book. But if you take only 3 months, it's approximately around 3%, less than 5%, I would say.
5% of 40?
Entire book.
So 5% less than 3 months and 35% 3 to 6 months. But apart from that, I think we are given moratorium beyond the regulatory requirement as well in certain customers, and especially those coming from the garment industry, those who are employed by the garment industry. We have quite a substantial portfolio with top tier garment manufacturers where we have supported them in terms of personal loan. We have gone beyond the minimum required, and so are some of the SME and corporate clients. We have granted more than what was regulated, so the moratoriums were extended beyond the regulatory requirement. That's again asking 3 to 6 months moratorium is less than 5%. I know 3 to 6 months is 35%, below 3 months is 5%.
Right. Yeah. About 3 months.
So there's a question on collection ratio, how the collection ratio has been for the quarter compared to the last quarter, and what's the collection ratio for July, and what are the expectations for the next 3 months. Sanjay, want to come? Collection, I believe, is you're referring to the personal loans and card side.
We have just reached the end of, almost reaching the end of the 6 months moratorium. So our collections teams are now ready to go with the collections, and also foresee the reschedulements in case there are the situations have not changed. So it's difficult to give a percentage, but we are in the process of reaching the clients after the moratorium period.
One good thing is the collection volumes are still manageable. We have, of course, strengthened the team and then proactively looking at expecting a higher number of collection calls and all. So far, it's manageable. And we also proactively looked at potential industries and gave them some individual solutions as well. But as Sanjay said, we need to look for the next couple of months how they are coming out, especially some of those entities where there were salary reductions and all. So naturally, would have difficulties in settling. So we may have to offer certain solutions to those clients. So we are proactively managing intern and also monitoring. We are ready with whatever the solutions for the deserving clients. There's a question on the in June quarter, which segments consumer versus corporate and sector did lending go? Also for the rest of the year, where do you see the demand coming? I would say that the demand for credit came from all sectors, but the bank was also choosing, especially when you're managing our balance sheet, you have to be careful in a situation like this. But however, we have seen a good uptick in retail side in terms of more granular lending opportunities coming. So we have been supporting that. Talking about the rest of the year, I think one segment that would grow naturally is this Saubhagya loan scheme. So as I mentioned, we have almost 7 billion that have been approved and then 5 billion already dispersed. Most of them dispersed in July. So June impact may be only 1 billion out of the total growth. And then there'll be a lot more with the credit guarantee scheme that was announced by the central bank, where up to 80% of the credit is guaranteed based on the value of the loan. So that would also contribute some growth in our book. But still, all the business segments are expected to contribute the project finance and the corporate side, and then also the retail and the SME side, along with the Saubhagya loan scheme that is now available for SME as well as even the export-driven corporates and project finance units, including the power projects and all. So I think that could have a balanced growth, but it would be a cautious growth that we don't want to have any aggressive growth in the first half. So there's a question on will NDB incur any additional impact on interest income during second half, or has the entire one-day loss due to the COVID moratorium being recorded? Yes, I think we have taken the one-day impact, so I don't think there'll be an impact to the interest income unless there is a credit default situation. But I think in terms of the interest revenue book, there won't be any impact to that. So there's another question on elaborate a bit more on the day one impact in the moratorium. Day one loss was taken if the modification is considered not substantial. So this 636 impact is for the loans which are not considered substantial. How much is that out of the total moratorium? So Andini, will you take that?
Yeah. So how the day one impact is computed is by considering this is actually impacting the EMI facilities of the portfolio of the total moratorium, which approximately is around 20% of the moratorium facilities. So that's on your EMI portfolio, and how we do compute it is based on the comparison. We are comparing the average tenor for maturity against the current present value, and we compute a present value difference. And so we have accounted for the entire day one difference. So if you take this EMI portfolio on our total portfolio, it's not substantial. So therefore, we have applied this day one basis.
There's another question on with much of new growth coming from Saubhagya scheme, do you expect margin to narrow for the next 6 to 12 months? I don't think so, because the new growth, what I mentioned was about, say, 7 billion. But when you compare that with the balance sheet, I don't think it's a substantial figure. Maybe about 25% of the growth might come from the Saubhagya scheme. The rest of the loan growth is coming from other loans. However, even these loans are booked at minimum 3% margin. So I don't think there'll be a big impact to the margins. So there's another question about any further reliefs or concessions planning to be given either by central bank or the bank for tourism industry, which will have a most prolonged impact compared to the other sectors. Certainly, yes. As we all know, tourism industry would require a longer time to come out. You may also recall that post East attack last year, there was a 1-year moratorium provided to the entire tourism sector and the support entities. So that moratorium ended in April, but on top of that, the COVID impact came in. So all those tourism related customers got another 6 months extension from April. However, as we all know, except for the local participation or patronized by the local tourists, the industry is struggling. So naturally, industry would require more time to revive. So certainly, as regulator is yet to come out with any direction, but I think most likely there will be a direction. But even though there is a direction or not, individually we are supporting our clients, good clients, and already we are given that support. But whoever who is having difficulties, we are quite prepared to provide that support. Hopefully, at least some part of the interest they should be able to service. That is important. Otherwise, we are extending quite a long duration for these exposures starting from April last year. So that can have a negative impact on the collection, the cash collection. Though you may accrue, there can be a impact like the day one impact to the bank. So that is something we have to be mindful of. So when the regulator also extend these moratorium, some portion of the interest, some companies who can make payments can manage, then it would help the banking industry to manage and give a longer duration for these deserving entities. But most likely there will be a longer duration given for these customers.
What if you copy them saying for you?
I think this question comes every webinar. What percentage of the loan book is on variable rates? I think Iran,
overall, it's almost about 70%.
So 70% of the book is on variable rate. So that's one way. In a low interest situation, sometimes you may not have that advantage, because if see, that means 30% of the book has been booked at higher rates. But on the other side, I think we are at the bottoming out situation in the interest rates. So the uptick is there for 70% of the book, but that also helped us to manage our interest rate risk in terms of again the time. If you look at the deposit base again, those are all variable rates, and then we don't have that much of 1 year fixed deposits. Most of the deposits are either 3 months deposits or savings and current accounts. So I think that way the interest rate risk is managed. There's a good question about the decline in interest rates. Have you started to see an increase in demand for housing loans? Do you expect industry-wide an increase in this segment? I think yes, we have seen good interest. Sanjay, you want to comment?
Yeah, I think we see a lot of people moving into investments, especially apartments and lands, and they're taking advantage of the low interest rates. So there is a demand. Of course, there is a heavy competition between the banks, but we are managing that. The advantage that we have is, for the customers is that we give 5-year fixed. So that's an advantage, especially when the interest rates are at the bottom. This is an advantage that the customers can get as compared to some other competitors who are on floating rates.
So naturally, when the rates are low, there will be opportunities for other type of investment. So that's where stock market is one option, and then in the housing side, again, as a diversifying your investment horizon. So I think that way we are seeing quite a good demand for housing loan products. Seems to have lesser number of questions this time. So there's another one on, have you seen a pickup in margin loans? Margin, we don't have a big exposure to margin trading portfolio. We have seen few queries coming. Sanjay again.
Yeah, I think very selectively there are few queries, and we have also given them some facilities. So we expect this to improve, especially with the group of companies that we have, especially ATB stockbrokers. So that's an advantage that we give. And also against the NDB Wealth, we have special rates offered for against their wealth management funds. So I think those can be taken for share investments.
Seems that we don't have any further questions. I'll give you a little more time if there are any questions. Okay, again, an interesting question. With the rates coming down, have you seen some of the borrowers refinancing their loans, which will impact the NIMs? There have been occasional requests coming from those under higher rates in terms of personal loans, and then selectively we have been supporting, but on the other side there is a prepayment penalty as well. So I think if even after paying the prepayment penalty, if there's a good saving in terms of interest, I think that in certain cases some customers have taken that call and booked in, but we have helped them. And also there are good requests for top-up arrangements, especially on the personal loan side. So naturally, this is a phenomenon when the rates are low. Naturally, people would like to rebook it and renegotiate it. However, in terms of NIM, I don't see a big impact because the cost of funds also have come down. And also the prepayment penalty also would come in as a fee income. So it may not reflected in the NIM side, but fee base, there'll be a fee charge coming in. So in the absence of any further question, okay, that's one more. On the salaried segment, have you had any many customers requesting relief due to salary cuts? Sanjay again. A lot of questions on the personal.
There has been mainly after the salary cuts, there have been requests for which we have offered the moratoriums based on the central bank guidelines, as well as we have gone out of the way and helped those clients. Actually some of the bulk requests that we got. Since we have quite a substantial exposure towards some of the companies, the main companies, which have gone for a salary cut. So we have given that relief for them.
Okay, so just to summarize, I think first half was a relatively better year for NDB despite all the challenging circumstances. You saw the numbers, the improvements in the balance sheet and also the profitability that we maintained despite the challenges. And also we use this COVID and then subsequent time to reflect and also re-strategize ourselves. So we have worked on a new strategic plan for the bank that would be deployed soon. In that, we'll be reviving some of our areas that we have been focusing on. One good area is the project finance and the development finance area, where now the country needs more support for up and coming export-driven businesses, smart tech businesses and all, where we see our skills and the capabilities to support them, advise them, nurture them. I'm sure we have that strength, so that is an area that we are going to focus on. Transactional based corporate banking, where across the bank stream, across the customer segments, to how we can support more so that we can work on our CASA ratios. We have strategized a lot, so those will be deployed very soon. And as I mentioned, the group capital market cluster contributions are expected to be more. There's a lot more restructuring deals available in the market, and similarly the debt capital instruments that are coming, including the real estate, REIT, and all. So that gives further opportunities for us to work on, and that's where we have been building a solid staff base, a very skillful staff base, and this is the time for us to deploy and capture those opportunities. So that's, despite, I think the challenges are behind, now it's a matter of focusing forward and doing better for the institute and better for the country. So looking forward to a better second half and in the years ahead. So thank you very much for taking part in this investor call or the earnings call, and looking forward to meeting you all again in the next quarter after our results are published. Thank you.